Welcome back to 15 Minutes of Finance. This is the tax plan, where I help you keep more of your money. Today's episode is about electric vehicle tax credits. And if you're anything like any of my clients, this is about the time of year where you start emailing me saying, hey, I had a good year. Is there anything I can do to lower my taxes? Is there anything I can write off? Are there expenses that I should be keeping my eye on? And happens every year with most of my clients, particularly the ones who are business owners. Maybe they had a really good year, a great season for their business. They had more income than expected. They're trying to lower their tax bill. It's going to be a lot higher than they expected it to be. And so these last 2 months of the year, for most types of deductions and most taxpayers, you're a cash basis taxpayer. You've got to do things in 2024 if you want to save taxes in 2024, your tax year. So a lot of people start using these 2 months really to tax plan and start figure out what are the ways that I can save taxes this late in the year. What are the kind of the last minute things that I can do? One of the popular ones, especially in the last couple years, has been to buy an electric vehicle. And legislation around this has changed. There's been new legislation. Certain legislation has been extended. States used to have their own tax credits. A lot of those have gone away. Some states still might. So there's a lot of complexity surrounding this, but it's a very common thing that people point to or look to as a way to save taxes every year. So we're going to talk about what is the electric vehicle tax credit, how do you qualify, and kind of what are some things to know to maximize this for you if it makes sense for you, okay? So the electric vehicle tax credit is basically an incentive from the IRS to encourage people to buy less fuel-dependent vehicles, start shifting the country towards less fossil fuels. And so one of the primary ways the government can do that is through tax incentives. That's one of the primary things that the U.S. government and the IRS can control a little bit to dictate spending habits, okay? So it's an incentive to move away from fossil fuels, and so they give a tax credit as an incentive to buy more electric vehicles, okay? So this tax credit is for taxpayers who buy an electric vehicle to give them a non-refundable tax credit on their taxes. So that's a really important factor. This is a non-refundable tax credit. So what that means is something like the earned income credit or the child dependent credit, okay? These credits are refundable, which means if I'm, let's say, below the poverty line, and I do have some income, I have very, very low income, and I have 2 kids, and I'm working a job. Without running specific numbers, there's a very high chance that I'm going to have a combination of child tax credits and the earned income credit, EIC, and those are refundable, so I might have only withheld $375 in taxes during the year on my W-2. I might get that back and a couple other $1,000 because I had refundable credit. So refundable means you can get money back from the IRS that you didn't even pay to begin with. A non-refundable tax credit is a tax credit that can only offset taxes you paid or owed during the year. So if I earn $50,000 and based on my tax bracket, I owe $4,000, I can't claim a $5,000 full credit. I get $4,000 of it. It offsets my entire tax bill. I might now get a refund of the taxes that I've withheld during the year on my W-2, and that extra $1,000 of the credit is wasted, so to speak. There's nothing to offset, and I can't get it refunded to me. So it's just lost in that tax year. So that's how refundable versus non-refundable credits work. So it's a little bit confusing because a lot of people think, oh, this is non-refundable, it can't get me money back. It absolutely can get you money back because if you have a normal job, taxes are being withheld from every paycheck, right? You're withholding income tax based on an estimate of what you expect your deductions to be, what you expect your income to be, whether you're married, whether you have dependents. All of those kind of answers and factors are on the W-4 form that you fill out with your employer. Anybody who has accepted a job has probably filled out that form. Those help calculate an estimate of the taxes that you're going to owe. And so then your employer is withholding per paycheck an amount that reflects what you should owe. And if you're doing it right, you should owe or get a refund of a very small amount. You might owe a tiny bit or you might get a refund of a tiny bit. If you have a massive refund, you should probably be adjusting those withholdings. You're just giving interest-free loan to the government. It doesn't really help you. It's fun to do your taxes and get a huge refund, but all that means is you should have had more money on every paycheck. So, because you're withholding money throughout the year on every paycheck, you might owe $3,500, in taxes, and you might have paid $3,900. So you're expecting a $300 refund at tax time, right? Well, if you have a $5,000 non-refundable credit, you're going to get your $3,600 back plus the $300 back that you overpaid. So you're going to get the full $3,900 back. You don't get the full $5,000 credit. That's the difference, right? A refundable credit, you would have gotten $5,000, $1,400 of it would have been refundable, meaning it exceeds the amount that you owe in taxes. In a non-refundable credit, such as the EV credit, you could only get a credit up to the taxes you paid. So it still will often lead to a refund for you, but it's not a refundable credit, meaning the credit can't ever exceed the amount you owe on your taxes. Okay. So let's talk about now this specific credit. It's a common thing. There are numerous clients that I know who have kind of done this calculation to decide if an EV car makes sense for them. That's redundant, right? EV means electric vehicle. Oh, an electric vehicle car, to decide if an EV makes sense for them. A lot of business owners deciding, should I buy this instead of another car? I need a car for my business. Should I get an electric vehicle to get a higher credit? So if you are considering this and you want to learn more kind of about does it make sense for you, here are some of the factors to consider for the electric vehicle credit. So first of all, let's talk about how much it is. So the maximum credit, and I believe this is now, it was extended semi-recently, as in within the last year or 2-3 years. It was going to expire at the end of 2023. It was extended, so I believe it's now all the way until 2032, if I'm not mistaken. All that to say, it's extended for several more years at least. And so it is up to $7,500, and there's two factors in that credit. There's a $3,750, so $3,750 critical minerals requirement, and then there's a $3,750 battery component requirement. So there's kind of two things in the construction of the vehicle and the battery and the way the system of the car works. And so the $7,500 credit is a component of both of those. So your credit could potentially be $3,750 because you meet the critical minerals requirement. It could be $3,750 because you meet the battery component requirement, or it could be $7,500 if you meet both. Most electric vehicles, hopefully I'm not talking without research here, but most clients I've worked with, they tell me the car, I look it up, and it qualifies for the $7,500. So based on my experience, I would estimate most electric vehicles do qualify for both based on kind of manufacturers want people to buy their cars. They are not ignorant of IRS legislation. If I know it, their tax people know it at Ford and Tesla and all these massive companies, right? So they're planning to construct cars that qualify for the credit because they know it incentivizes their consumers to buy their cars, right? So if you just think about the incentive structure here, most vehicles are going to qualify based on the incentive structures of the companies that make them, right? That just makes sense. So there's a good way to look it up though. So if you're thinking about buying a car, you can go to fueleconomy.gov, and there are some tools here. You can look up your car. Less than a page down. So I'm looking at it right now on my computer. I can see it at the bottom of my screen. So within one view, you'll see blue letters that say search for eligible vehicles. And then you can search based on the make and model and all that stuff. And the date that you plan to take delivery of the vehicle and all that stuff. So, you can look up cars just to make sure that you would qualify for the full $7,500. Okay. Again, it's a non-refundable credit, meaning if you don't owe $7,500 in taxes, you won't get the full $7,500 credit. All it can do is erase the taxes that you owe. You're never going to get money back that you don't owe. So keep that in mind. If you don't owe each year, if you're whatever line on your tax return. I don't have a tax return in front of me now, but if the line on your 1040, let's say from last year, go to last year's taxes, look at the line that says total taxes that you owe. If that line is less than $7,500, just know if your situation is similar this year, you're probably not going to be able to get a full $7,500 back. Okay. So not everybody qualifies in terms of income. So there's also income phase outs. Okay. So for married couples, your income can't exceed $300,000. That's your adjusted gross income. We've talked about this a little bit in previous episodes. We'll probably have an episode about it, kind of helping you understand these different numbers. Adjusted gross income is your income after some adjustments. We've talked a little bit in previous episodes about the difference between above the line and below the line deductions. I believe off the top of my head, things like student loan interest, contributions to a traditional IRA, those are adjustments above the line to arrive at AGI. So your AGI can sometimes be a little bit lower than your actual income because you might have some adjustments, some deductions. So, but for the purposes of simplicity, just kind of think of your income, so to speak, $300,000. And like most things, it's half of that for a single filer. So $150,000 if you're a single filer. So just understand if you're a really high income person, you're making $550,000 between you and your spouse, you're probably not going to be able to qualify for the electric vehicle credit. Okay, so it's not for the ultra high wealthy individuals. This credit's not really available to them. So keep that in mind. Just know don't buy an electric vehicle expecting to get $7,500 back, and your income's high and you get nothing, and it kind of really throws off why you bought that car to begin with. So those are the key components. It's non-refundable. It's the income threshold. If you're married, you got to be under $300,000 in income. If you're single, you have to be under $150,000 in income. And then the credit amount, there's two components that for most people will add up, or for most cars will add up to a total of $7,500. Okay, so those are the components of the electric vehicle credit. So now let's talk about a couple kind of deeper levels to this that you might not know. One is really cool. So the IRS actually allows you to use your AGI from either the current year that you got receipt of the vehicle, that you put the vehicle in service and accepted delivery, or last year's, the year before you took delivery of the vehicle. So if you had $213,000 in income in 2023, you buy a vehicle this year, you had a great year, and you had $380,000 in income this year, you can actually use your AGI from last year, which would qualify you for the credit, and then get a credit this year for an electric vehicle bought in 2024 on your 2024 tax return. So that's a really cool element of it. So just know that if you heard those AGI numbers and thought, I'm phased out of this credit, that's a bummer, it's not really something for me, just know, look at last year's tax return, look at 2023, because if that AGI is low enough to qualify for this credit, you could still get the full $7,500. So just understand that. It's a very cool thing. I don't see that necessarily published very often in kind of the literature and the kind of one-page car dealership ad type of information about this credit. Not a lot of people talk about that element of it. I think that's pretty cool. Next, we're just going to kind of talk about kind of how to plan around this. So the first thing to consider is the $7,500 credit means if you're comparing two vehicles at a very baseline level, if you pay, or not necessarily pay, I think a lot of people consider paying taxes as what they pay at tax time every year. I mean the total amount that you owed, including all of the withholdings from your income. So if the total amount you owed in taxes is above $7,500, meaning you could claim the full credit, you can just kind of deduct $7,500 from the cost of the vehicle if you're comparing two vehicles, right? So if one vehicle is $50,000 and it's an electric vehicle and your other option is $45,000, well, you know that buying the $50,000 electric vehicle, if you meet all the requirements, is going to get you $7,500 back on your taxes. Really, that vehicle costs $42,500 and it's cheaper than the $45,000 vehicle, right? That makes simple mathematical sense. So that's the first kind of way you can use this information to plan. If you just want an electric vehicle, this is a bonus for you. It's like, oh, cool, you wanted an electric vehicle, you really like how a Tesla looks and drives, you might as well buy it this year because you're going to owe a lot of taxes. So buy it now, get the tax deduction for it, right? So that's a major kind of consideration. There's also the element of timing out your kind of when you get the deduction. And here's what I mean by that. A lot of people don't buy cars fully in cash, right? They buy it on a payment plan. Maybe they put 10 down or 5 down, and then they pay the rest over the terms of the loan, right? The IRS, in terms of a vehicle credit, or even for business owners in terms of depreciation deductions, they don't care how much cash you put down. Now, I'm not talking about a lease situation. I'm talking about a car you did buy and own. But if you bought it on a payment plan, maybe you can put $5,000 down or even $3,000 down, put it on a payment plan, okay? And now you own the car, you bought it in 2024. Maybe I had $10,000 in taxes. So I'm going to get the full $7,500 back. So in terms of my cash flow over the course of 2 to 3 months, I'm $4,500 better off, right? Because I got $7,500 back. I only had to put $3,000 down. My cash is higher. Now, obviously, you need to consider that there's interest on loan payments for vehicles, and there might be fees and stuff to finance, and maybe there's a couple other random service charges and upfront fees because you went the financing route. So I'm not recommending people heavily debt leverage electric vehicles just to get this credit. Okay, that's not my advice. But there are a lot of people who maybe, for example, a CPA, your car breaks down. You're a CPA who meets a lot of clients. You're going to sites. Maybe you're a CPA who does other types of consulting. So you go to job sites and you do fractional CFO work, whatever, right? And you need a new business vehicle. You know, tax season's coming up. You've got $120,000 of, invoices lined up that are going to get paid over the next 3 to 4 months. Okay. But cash is really low now. You might want to buy a vehicle, put nothing down, get a $7,500 credit. Tax season ends, you get over $100,000 cash flow in, and then pay off all the vehicle immediately, the remaining balance, right? And so you were able to get the credit in a year where you owed a lot of taxes, and you were able to increase your cash flow for a short period, and then your income that you expected came through. You pay off the car, you avoid most of the interest because you paid it off super early, and now you're kind of in a better situation because of the way that you timed that out. So again, I'm not saying heavily leverage car purchases that you can't afford to get credits. What I am saying is for business people, for higher net worth individuals, there's a lot of people who have enough income that this is not an irresponsible purchase. They're just trying to time out cash flows. And so there is some leniency here in terms of when you buy the car and get the credit versus maybe the time that you actually pay off the full balance of the car is early on in the following year. And so you can make sure you get the credit in a year when you have a lot of taxes. Maybe you're in a high marginal tax bracket because of a promotion or something like that. And so you want the credit now and then you'll pay it off soon. There is some kind of timing consideration. The important thing to take away is that purchasing the vehicle, owning the vehicle, and having delivery received of the vehicle qualifies you to take the credit. I almost said irregardless again. I keep doing this, and I know every time I do it, my mom's going to be upset because irregardless is a stupid word. Regardless means exactly what you want it to mean. So regardless of the cash that you put down, the ownership of the vehicle, buying the vehicle, regardless of cash down, still qualifies you to take the credit. That's the important kind of takeaway from this point that I'm trying to make. All right, everybody. Well, that's it for today's episode. I hope this helped you kind of understand the nuances of the decision-making process on electric vehicles. Does it make sense for you? How much can you maybe expect to get back by buying an electric vehicle? Do you qualify for an electric vehicle? And there's that resource for you, fueleconomy.gov, that you can use to kind of calculate if an electric vehicle that you're looking at could qualify you for the credit to make sure you don't buy a vehicle and then get surprised that it doesn't qualify based on the requirements, or maybe it only qualifies for $3,750 in credits rather than the full $7,500. As always, we always welcome and appreciate questions, topics for future episodes. We'd love to cover those topics in the future. We'd love to answer your questions in future episodes. Hope you learned something. And as always, invest early, invest often. See you next time.